The streaming world is facing one of the most consequential power shifts in its history. Netflix is attempting to acquire the studio and streaming assets of Warner Bros. Discovery in a deal valued at approximately $72 billion. This package includes the Warner Bros. Film and TV studios, HBO and Max, DC Entertainment, and a massive library of intellectual property that has shaped global entertainment for decades. At the same time, Paramount and Skydance have entered the arena with a far larger, mostly cash-hostile bid of roughly $108.4 billion for the entire Warner Bros. Discovery company. Reports indicate that sovereign wealth funds from Saudi Arabia, Abu Dhabi, and Qatar are prepared to supply significant financing for the offer. The outcome of this bidding war could redefine the competitive landscape across Hollywood, Silicon Valley, and Wall Street. Netflix's motivation is strategic and long-term. The company already dominates global distribution, but it lacks the kind of legacy IP library that drives multi-platform cash generation for decades. Warner Bros. Owns exactly that. Harry Potter, DC, Game of Thrones, The Last of Us, Dune, The Matrix, Looney Tunes, and countless other evergreen franchises. Owning these rights would transform Netflix from a pure streaming platform into a vertically integrated entertainment powerhouse with control over production, distribution, licensing, theatrical releases, gaming, merchandise, and international rights. Analysts note that if the deal is approved, Netflix's share of the U.S. subscription streaming market could climb above 30%, giving it unprecedented leverage in negotiations with creators, telecom carriers, advertisers, and global distributors. In other words, Netflix wouldn't just be competing in the streaming business, it would be shaping the rules of the entertainment economy. Warner Bros. Discovery's incentives are different. The company has been weighed down by structural complexity, high debt, and inconsistent cash flow for years. Leadership had already announced plans to split the business into two parts, one focused on streaming and studios, and another holding the global linear TV networks. Selling the entertainment division to Netflix would accelerate debt reduction, simplify operations, and deliver shareholders a sizable exit valuation during a period of market uncertainty. But the Paramount, Skydance bid changes the picture dramatically. Unlike Netflix's focused acquisition, Paramount is attempting a full takeover, all assets, all networks, all operations. From a shareholder perspective, the $108.4 billion headline number looks more attractive. However, the regulatory, political, and integration risks are significantly higher. A merger financed partly by Gulf sovereign wealth funds could face geopolitical scrutiny, and combining two legacy media companies at that scale would be a formidable operational challenge. Regulation is the biggest unknown in both scenarios. A Netflix Warner deal would create a vertically integrated giant with extraordinary control over IP and global distribution. U.S. and European regulators will inevitably question whether this level of concentration could restrict consumer choice, suppress competition in licensing negotiations, or give Netflix disproportionate pricing power. Some analysts believe the approval process could take years or require divestitures that reduce the deal's strategic value. Others argue that competition from Disney, Amazon, Apple, and YouTube is strong enough to prevent the deal from being labeled monopolistic. Financial markets have reacted cautiously. News of the potential deal triggered short-term volatility in Netflix's stock, including a brief decline of around 4%. Investors are concerned about borrowing. Netflix would likely finance part of the acquisition with new debt, reviving fears about the company's leverage in a high-interest rate environment. Integration risk is also real. Netflix's fast, data-driven culture does not naturally align with the traditional Hollywood studio structure that has defined Warner Bros. For a century. Misalignment in culture, leadership, and creative processes could delay or diminish the expected synergies. Still, the long-term upside is undeniable. If Netflix successfully integrates Warner's assets, the company evolves into a diversified entertainment conglomerate with multiple revenue streams far beyond subscriptions. That shift could fundamentally change how the market values Netflix, giving it access to higher, more stable cash flow multiples associated with major global media companies. Warner Bros. Discovery, regardless of the winning bidder, stands to benefit in the near term. Either deal would reduce debt, streamline the company's structure, and offer shareholders a substantial premium over current valuations. The bidding war itself has already created expectations of an even higher control premium. For investors, the situation breaks into three realistic outcomes. If regulators approve the Netflix deal, Netflix becomes the most powerful content-driven entity in the streaming era, though short-term volatility and integration challenges are likely. If the Paramount, Skydance bid succeeds, Warner shareholders receive a larger payout, but the resulting company faces the heaviest regulatory and strategic uncertainty. Ironically, Netflix may benefit in the long run by avoiding additional leverage. If regulators block both offers, Warner continues with its planned restructuring and the industry enters a slower, more fragmented consolidation cycle. No matter which scenario materializes, the signal is clear: the streaming war has evolved. It is no longer a battle over platforms. It is a battle over who controls the most valuable and enduring intellectual property. The winner of this contest won't just dominate screens. They will shape pricing, distribution, cultural influence, and the future economics of global entertainment.